Good morning, everybody. Welcome to our fabulous webinar we have planned for this morning. We're happy to have you. This particular webinar, we've assembled a really a top-notch team of experts in the area of cash management and cash flow. The title is Unlocking Hidden Cash in Your Business. So I'm Bruce Singer, and I'm a CEO of CFO Services by Bizon Capital Corporation. And what we do is provide chief financial officers to companies on a part-time basis and a fractional basis and a contract basis. So before we start the actual discussion, let me introduce our panel of experts and tell you a bit about themselves, and then we'll get right into it. Thank you. Katie.
Hi, I'm Katie Mills with Embus Consulting. I am a seasoned financial executive providing CFO services on an interim basis to both global multinationals and small to medium-sized businesses. I have international experience. And typically, I'll go into companies and provide financial leadership and operational finance support to companies looking to restructure or reposition to restore their businesses to profitability and solid cash flows. And I also work with companies to establish strong risk management and corporate government strategies and policies and procedures. I have a solid record working with companies, helping them to reduce costs, grow top line sales, and achieve sustainable cash flow and profitability. The keyword sustainable. I'm really looking forward to working with the panel, and I'm going to turn it back to you now, Bruce.
Thank you. Thank you. Okay, Mustafa. Mustafa.
Sure. Hello, everyone. My name is Mustafa, and I help companies in optimizing their working capital, streamlining their treasury operations, and help them establish the strong finance function. And similar to Katie, my background is in finance and treasury, and this is the forte. Back to you, Bruce.
Thank you. Scott?
Thanks, Bruce. I'm Scott Spence. I'm the Managing Director of FundSquire Canada. FundSquire is an R&D financing company. We're in Australia. I'm Australian, as you can tell. Australia, UK, and here in Canada. I'm based in Toronto. We spend most of our time thinking about cash flow and how to maximize our clients' cash flow in the startup and early stage business sector. So yeah, most of what I'm doing is looking at their R&D, how they can make the most of that through financing, and also connecting them with others in our network. So yeah, let's looking forward to today, and back to you, Bruce.
Thanks, Scott. Doug Samuel.
Thanks, Bruce. I'm Doug Samuel from Shred Clinic. For those who don't know what Shred is, it's an innovation tax credit to encourage companies to extend the capability of technology. Unlike the others on this panel, I have a technical background, and Shred is technical first and then financial. And I come to the financial side through that route. And I welcome any questions about Shred. I noticed quite a few people don't have exposure to it. So at the end of this, when there's a Q&A section, then please ask. I'm also a Shred audit expert if anyone has questions about that. Thanks, Bruce.
Wonderful. Melanie? Melanie Russell?
Hi, I'm Melanie Russell. I am a business evaluator, and I run a firm called Calyx Valuations.
Thank you, Melanie. Okay, so we're going to get right into it. This is going to be really, really good. Okay, I'm excited. Okay, so I'm going to start by asking the question. I'm going to fire a question here. What are the initial challenges and barriers and potential opportunities with respect to cash flow as companies are basically ramping up for a return to operations? Mustafa?
So, sure, I can definitely take that. Thank you very much. This is the most important question, Bruce, as a matter of fact. But before we get into the challenges and opportunities in that, one thing that it's more, I would say, let's call it accounting 101 or finance 101, is the cash forecasting. There are two different types of cash forecasts. As I call it, the controller's view of the cash forecast and the treasurer's view of the cash forecast. The controller's view, we all know, coming from finance background, is the statement of cash flow that is presented with the financial statements. But the treasurer's cash forecast is something that deals with the inflows and outflows on a daily basis. In a short term, as you've rightly said, as we reopen the businesses or ramp up our businesses during this unprecedented times, what is most important is, as we all call it, cash is king. The cash forecast, proper cash forecast is the most important thing. So the treasurer's view of the cash forecast is something that the companies must have a good view on and a good handle on. Alongside, of course, the cash conversion cycle as well, that we'll get into later on. And these two things will play a critical role in managing a good day-to-day business operation.
Thank you.
So speaking of the cash conversion cycle that we talked about, maybe I can further elaborate on that cash conversion cycle. Maybe a little accounting 101 for those of you who are non-finance participants in the webinar today. The cash conversion cycle is basically what a company spends on. What are some of the things that we spend on, like the inventories, the accounts payable and all that. And that gets moved on into when we collect those funds from the customers. In other words, I could say it traces the life cycle of cash used for business activity. It follows the cash as it first gets converted into the inventory and accounts payable and then into expenses and all that. And then through sales and accounts receivables, finally comes back to us. So lower the cash conversion cycle, better it is for a company. And maybe as we were talking in the introduction, I can pose a question to Katie. She has good experience in cash forecasting and all that. Katie, what are some of the challenges and opportunities you see in managing the cash conversion cycle, in lowering the cash conversion cycle? As I've mentioned, lower it is better.
Thanks, Mustafa. I think one of the things that we need to identify or highlight in today's world is that as companies are looking at their cash conversion cycle, their cash outflows and their cash inflows, and try and optimize the availability of cash in their business, there are government requirements and restrictions in some cases for additional costs to be incurred as businesses are reopening or ramping up their operations if they've been able to keep going through this period. PPEs, social distancing, ensuring that you're maintaining that within your business operation, not only for your employees, but also for customers and vendors, anybody coming into your operation. Additional costs incurred for sanitization and cleaning. These are just a couple of things. So everything that a company does right now to try and preserve cash, you have to also, as you're forecasting out the next 13 weeks or whatever time frame, that you're also considering, are there going to be some unexpected costs or some non-recurring costs that you need to factor into that? So just, very quickly, the first thing to look at is your operating costs, and if there are some opportunities to pick some low-hanging cherries and reduce some of those operating costs, hiring freezes, seeing about deferring costs, looking at your insurance coverage to see if anything can be covered under your business interruption, and or with your key partners, whether they're customers or vendors, and whether you can take opportunities from that. The other thing you need to consider is looking at your strength of your tier 1 and tier 2 suppliers and customers, because they will have been impacted just like you are in your business. They will have been impacted. So it's very important to have open communication and dialogue so that you know if your key suppliers are in good health and going to be able to support you as you're opening back up. This is also a prime opportunity to revisit your contracts with your key vendors and your key customers, but in particular your key vendors, to see if there's some renegotiating room in your contracts to defer payments, to be able to take advantages of some discounts. take advantage of perhaps looking at lower minimum order quantities and delivery schedules. You're not necessarily going to need the same level of raw materials and goods coming into your business initially as you're just starting to ramp up. So there may be some opportunities there as well. The other thing to look at is, have you got a backup plan? Are there alternative suppliers? And again, in today's world, you do have some opportunities to be able to look at renegotiating or negotiating new terms that are going to be more favorable to freeing up cash in your business. The other thing, and Mustafa will be talking to this a little bit later on in the second portion of the webinar, your letters of credit with suppliers. If you're serving offshore with customers, if you're serving offshore customers, you may very well need to revisit letters of credit and make sure they're still valid. So I'm going to turn it back over now to Mustafa to talk a little bit about supply chain financing. I think he's just going to mention a few things, which again will be coming up in the financing section.
Certainly, Katie. Thank you very much. Before I talk about supply chain financing, I think one thing that comes to my mind, and this is on the fly, is you talked about the international suppliers. So FX would be something that would be of great
very much
importance.
so.
Yes, exactly, would be of great importance. In fact, in tomorrow's webinar, tomorrow's part of the webinar, we will be talking about the FX and the hedging strategies and things like that. So definitely make sure that tomorrow's webinar, you're not missing on that too.
Mm-hmm.
So that was a good mention. And the supply chain financing is definitely a product that through which, as Katie, you mentioned about the relationships with suppliers and all, we'll get into more details as one of the financing options available. But I wanted to take this opportunity to talk a little bit about Shred. As Doug mentioned, I'm intrigued about that. So maybe, Doug, I can hand it over to you. We can go a little back and forth on this as well, if you like.
Sure. Yeah, actually, I had a question for you though first, Mustafa, because as you know, Shred isn't always certain whether you're going to get it or. How would you actually forecast your on hopefully getting Shred?
So great question, Doug. Shred is probably, I would say, the most difficult thing to forecast. And us accountants being the more conservative bunch, as we call ourselves as, I would rather stay away from forecasting it. I would probably, and especially when this is my first year, I have no idea or experience on what would be admissible and what would not be admissible. So I would say maybe high-level salaries, maybe high-level some material expenses and all that. But that's pretty much it. But my conservative accountant would probably stay away from that. But maybe I can ask you, educate us about what are some of the risk and opportunities you see in forecasting Shred?
Yeah, I mean that's a great point because I think it is possible to get some idea of what your Shred might be. So I think that the opportunities, particularly coming up in the current situation, is I think a lot of companies are going to see that as the world changes with COVID, they're going to have to innovate not only in terms of how they operate their business, but even the technology that might support their business. So any business who's really looking at I'll just preface this by saying Shred isn't what you do with technology, it's what you do to the technology. So any business that maybe brings in some technology from someone else and finds that it doesn't really work, particularly in the current COVID situation, doesn't meet their needs, may have to experiment to try and get that technology to do what they need it to do. And that experimentation is precisely what Shred is. There's no obvious answer. Can we make it work? Maybe we can't make it work. Even if you fail to get the results you want, you can still claim that. Another opportunity that I'd look at is what I'd call internal Shred versus external Shred. So to me, external Shred is your product. So if you're creating a product or service that is in itself technology, that's where most people look for Shred. But I'd urge businesses to also look at the internal processes and the technology required to deliver their product or service or make their product. There can also be shred there. On the risk side, sometimes the companies think they have shred and it's less eligible than they think, simply because it's an innovation in the marketplace, but the technology itself may not actually require a lot of experimentation. So they may find they don't have the shred that they think. And the other big risk is if the claim is weak. So yeah, it might be shred, but the auditor may not like it. So if you're counting on that money and you don't do the audit, that can be a risk as well. The best way to shore up those risks are really to have a good solid claim so that the auditors like what they see and don't actually come in and ask questions. So Scott, actually I have a question for you, because in terms of when we look at the risks around shred and the fact that we're making expenditures now, but we can't claim until next year, is there a way of getting the money I'm spending now on shred and being able to spend it sooner than later?
There definitely is. Yeah, that's basically what our business and others like ours do. I'll just go back to, I think, Mustafa's point. When we were talking before the webinar, how Mustafa mentioned that, yeah, he finds some difficulty in forecasting shred. I mean, that's what we do. So that did surprise me a little bit. That's my life, basically, is forecasting shred. So to address that, I think, you know, we'll look at a customer's history with the program. It is difficult for a first-time claim to forecast how much you're going to receive. It's very much retrospective. So working with a consultant who's experienced, or a company's that experienced, super important in setting yourself up correctly to receive the money that you're entitled to with the refund. As far as going forwards, I mean, a lot of it is salary based, materials based, or third-party contractor based. You can forecast out what your salary spend is going to be in your cash flow forecast or your budget, and you can, you know, I see companies put their shred receivables on their balance sheets as assets, which they can lend against in the future with the right lender. How a company does it and why they do it is, you know, it's a business decision up to them. If they can see the return on investment of moving that future receivable forwards 6-9 months, yeah, I mean, there's definitely a use case for that, especially with high growth businesses or businesses looking to improve processes or improve technology.
Okay, so if we move on and talk a little bit about some available financing options, I have a general question for the panel, and maybe we'll start with Katie. We know, we've heard since COVID has started that there has been a lot of government intervention and government assistance. BDC and other banks have stepped up to the plate too. Some have done it right away, and some have done it slowly or slow over time. So in order to improve cash flow, what is the panel seeing out there in terms of financing options available either through government programs or through financial institutions? Maybe we can start with Katie.
Thanks, Melanie. Mustafa and Scott are going to go through in a little finer detail some of the opportunities that are out there. I think the first thing companies need to be looking at is their existing lines of credit and debt service that they have, that they're carrying. It's really important for companies to have open and transparent communications with their financial institutions right now, and particularly making sure that their existing lines of credit are still in place. They're still available to them, because everybody's business has changed dramatically over the last 4 months. Some of the things that companies can do and should be doing is exploring options within their existing debt agreements and lines of credit to see if their financial institutions are flexible around waiving or loosening up some of the debt covenant requirements, looking at debt service holidays, looking at extensions. And by default, that's going to free up some cash if the financial institution is willing to work with the business. The other thing is to look at borrowing capacity on unencumbered assets. So, where you've got guarantees for loans, are there other assets you can use to either expand existing debt services or look for new opportunities of lines of credit? A couple of things that you can do, or one of the things you can do as well, is looking at swapping fixed assets for variable costs. So what I mean by that is looking at sale and leaseback on assets. A typical one is your network infrastructure and computer systems, where you can actually sell it to a leasing company and then look at leasing it back over a fixed term. Immediately you've got the cash coming back in from the sale, and you've got lower payments generally than what you would have on financed assets. Transportation leases, where you've got vehicles, whether it's trucks and large transports, or whether you've got cars in a fleet of cars for your salespeople in your organization, looking to finance looking to lease rather than buying them outright or financing, which generally speaking, you're going to be paying premium amounts on. Those are just some simple things that organizations can do very quickly. More specifically, Mustafa, are there things that are available to businesses today?
Sure. Thanks, Katie. You've actually set the stage right for these things. There are definitely some bigger options available. We talked about the supply chain financing earlier as well. I'm going to get into that, but there are a few smaller things as well, which I call them maybe low-hanging fruits to improve your cash conversion cycle, as we were talking about. Could be a consideration of a virtual card program for paying to your suppliers, which actually helps you extend your payment terms with the suppliers. Or if your collections are through maybe checks, consider EFTs or lockbox services, or maybe have some merchant services available in your businesses. Some low-hanging fruits type of thing that I thought I'll bring up. To Katie's point, have very strong relationship built with your banking partners. They are an essential part of your business. They are an essential service provider. Make sure that is there. One of the financing option that is available during this COVID time is the financings that your relationship bank could actually procure for you. However, those will be guaranteed at least up to 80% off, or 80% portion through the Business Development Bank of Canada or the Export Development Canada. These are some of the options that you should be able to consider. There are more definitely things available on that. We call that BCAP program. So talk to your financial institutions, talk to them about how you could leverage, your organization could leverage the BCAP program. The financings that are available could be starting from maybe as little as $6 million to even $12 million could become available for your organization. So this is something that is available. Katie alluded to the letters of credit. We are in a time where challenges are not only with the supply chain or the companies, but there could be some banks as well, especially overseas banks, that may have issued letters of credit to you. So make sure that you validate the viability of those letters of credit, whether those letters of credit still hold for you. Speaking of that, if you're an exporter, Export Development Canada, EDC could actually be of great help to you by ensuring your accounts receivable. And that not only ensures you against any contingencies or anything like that, but it also can actually give strength to your borrowing base if your credit facility is asset-backed. So that could also strengthen, again, having a strong relationship with your financial institution will definitely help you get there. Last is the supply chain financing. My favorite topic, as I call it. Supply chain finance is a beautiful product. What it does is, if I'm a company and I have a greater credit strength, as Katie was alluding to earlier, we can actually negotiate better credit terms for the companies who are our suppliers and may not have as good a credit rating. Banks provide this service. It's not as commonly understood. Supply chain finances generally get classified into one of the maybe fintech operations or fintech type of a thing and all that, but it's none of those. Supply chain finance beautifully helps your suppliers with getting the payments for the products that they're delivering to you faster, while you not having to pay that fast to them. So it's a win-win. Supply chain financing creates a win-win situation for all companies. So this is something that I would strongly urge you to look into for the viability of your operations. So that was from my side. Yes, Katie.
Another thing on the supply chain side that the Chinese tend to do this very efficiently is collaborating with key trading partners to come together and use collective buying power in the supply chain, and that way you're spreading the risk. You're not bearing the risk of the supply chain alone. So that's another opportunity that's there.
Absolutely. Thank you, Katie. So back to Melanie, I guess.
Great. So I think we have a few questions. I think we're to the point now of checking some questions from the audience. I also have some questions, if that's okay. In general, for everyone on the panel, do you have any predictions on changes to the government programs or financial institution programs, maybe after the summer or coming up, if they will look different than they look now?
We can definitely park this question, Melanie, for a little bit. There was one question that I was thinking of. I'll answer this, changes to the government funding timing. Since we are talking about financing and all that, maybe Scott can enlighten us on some other alternate, because he's an alternate lender, not a regular financial institution. So maybe I can ask Scott about what's your point of view on some of the alternate financings that could be available to us?
Yeah, I mean, so a lot of the companies in our portfolio and the companies in our network are not eligible for maybe BDC or EDC financing. They're still too early stage for that sort of financing, or they can't access traditional products. So there's a fair few things available for them. It generally falls into, I guess, the secured versus unsecured financing from alternative lenders, and how different players in that market structure those deals for these companies. So on the secured side, you've got essentially asset-based lending that Katie was talking about. So, you know, it might be equipment financing or even building like maybe not second mortgages, but just any assets in the building that you can leverage, machinery perhaps. As far as what the fintechs are doing and the alternate lenders in that space, you've got different players in the market with revenue-based financing. So they'll essentially lend against your future revenue in a way, and then take a piece of the revenue as it comes back in. You've got SaaS financing, so it's for the software as a service businesses. One that I only recently learned about, maybe 6 months or so ago, was IP financing. So it's another option for businesses. I guess the idea is, if you can't access traditional financing, think about what's in your business and what you can leverage. And if you're willing to leverage that. With any financing, there's risk. If you don't have, for businesses that we deal with, if you don't have a solid path to revenue and a solid path to perhaps profitability and a way to pay these financing products off, they do come with risk. Oftentimes they might come with a personal guarantee as well. So as a founder or, CEO, maybe you're having to guarantee that personally. So, there's risks involved with a lot of these products. I'm not sure how they're performing now with drops in revenue as out there as well. So yeah, it depends on what your business is doing and what you can access, especially in our world. That's why we lend against a shred asset. It's easily repaid, and for businesses that might be pre-revenue, there's a nice way to end that facility and move on to bigger and better things.
Can I ask you a quick question? How fast can we get the money? So you have a shred. How fast is the turnaround to get the cash?
For me, we can do it in 48 hours. So
that's pretty good. That's really good.
Yeah, we're pretty quick.
Especially at this time. Okay, thank you.
Yeah, to answer Melanie's question about where we see government funding, we've got, I guess, some insight into how the UK and Australian governments are doing, how they're supporting businesses as well. Canada, the UK, and Australia have been reasonably similar in how they've responded. Overall, they've been very accommodative. This is the first time I've seen such a massive and quick response from the government. So going off that itself, I'd say they'll continue to be accommodative, at least in the short term. I'm not sure how that'll play out long term, whether there's austerity coming in years down the track or not. It's very hard to say, but at the moment, all the governments, at least in Canada, Australia, and the UK, have been very supportive of businesses, and I hope that continues.
Okay, thank you.
I just want to point out that, if you're looking for cash, hidden cash in your business, Shred is retrospective. So you're always looking at last year. So if you think you may have done Shred eligible work in 2019, you can certainly claim that. And assuming a December year end, you still have exactly a week to do 2018. So you better get cracking on that one if you think you have anything there. And then that takes anywhere from a month to 3 months usually to pay out, sometimes longer. So you're not going to get the money right away, but when you're looking at sort of, I'm going to call it found money, you didn't realize you had a claim last year and suddenly you find you do, there's no real risk, because if you don't get the money, you don't get the money. You're not, as long as you're not leveraging it through Scott's financing for this year's Shred to get the money this year, go ahead and file it. If you have a good claim, you could get some money in a few months.
Doug, I have a question to ask you. A lot of companies, like some companies have Shred, but don't know they have it.
Mm-hmm.
Like, what advice do you have for a company like that? People don't know what they don't know, right?
Oh, yeah, that's a great
story
question.
once you had a company that had Shred, didn't even know they had Shred, because they might have hidden money and not even know it. Yeah.
It's a great question. So the first thing I'll say is that a lot of people assume because Shred is technical in nature, you have to be a technology company. And that's absolutely not true. I actually did a Shred claim once for a cold storage company, believe it or not. Now, I'm not saying that every cold storage company has Shred. That was a unique project they had, but any industry could potentially have Shred. So you're just looking for, first of all, are you using technology? Then talk to your technical people and ask them, have there been problems? Did you have to go beyond what the technology said it could do in order to get whatever results you wanted, and maybe experiment to get that? Then that is a good marker that it's not necessarily Shred, but it's definitely worth looking at in that case. And also look at how much effort was spent, because if it took them a week, well, maybe it's Shred eligible, but a week of work doesn't amount to a hill of beans. But if it took a long time, like months, then A, that's obviously pretty complicated and has a higher chance of being Shred, and B, the expenditures are going to be higher.
Sure. And what about testing? Because you can test your testing. How does testing apply? What if you have it all done, but then you have a testing phase? That's also Shred eligible, right? All the labor. So you might have even more Shred.
Yeah, you could have more Shred. So testing is support work. So it's not in of itself Shred. So let's say your company needs some equipment, and there's 5 different suppliers, and I don't know which one suits us. I'm going to try each one. Well, that's like, which car do I want to buy? You just go test drive them and you make your decision. That's not Shred. As soon
We got
Doug, I think you went on mute.
I went to you there. Sorry, I'll just back up. I'm not sure when I went on mute. So if you're testing someone else's equipment, that's not Shred. But as soon as you look at that equipment and say it doesn't meet our needs, and you start to attempt to advance its capability through experimentation, now any testing you do is support work, and therefore you can claim it.
Got it.
I have a two-part question for Doug. Yesterday, when we were preparing for the webinar, the question came up in today's environment where companies are really looking to preserve as much cash as possible. Is there a decision point where you say, I'm going to continue to invest in R&D that could potentially lead to a Shred application or Shred money's coming in, and when do I say, no, I need that in the business? So can you give some insight into that kind of decision point?
Yeah, it's a good question. I don't tend to look at it from that point, because I think that's really a business decision in terms of, will this technology help us? But I think there are some things in terms of getting revenue in, because that's what we're talking about. But I think there are some things well worth considering in the current environment. So if you think you can risk a certain amount of money to advance your technology, I think right now you'll probably have a bigger pool of talent out there to draw from, because the technology sector has been pretty solid, but definitely some good people have lost their jobs, and they're available now. So you might be able to get some good people in. And if you invest now, you'll hopefully reap the rewards in the future. And Shred is a way of making it cheaper. And a third thing that I'll add is that if you have consultants and there's any way that you can see that makes sense from a business point of view to bring them on as staff, that'll double your Shred claim. It's like, let's say your Shred claim is 100% labor and it's all contract, and you brought them all in as staff, you instantly double your Shred claim. Now, I don't think the tail should wag the dog, so don't make that decision just for Shred. But if it makes business sense, you should know that it'll improve your Shred claim.
Melanie?
Great. Thanks, Doug. So I have a few questions, and I think we have some from the audience as well. So, and one of my questions feeds into someone's question from the audience as well. So this is probably something that both Katie and Mustafa can address in general. So what has your experience been in terms of changing requirements of financial institutions for lending, and whether that's you've seen had a different experience by industry? And also Purva's question was, Katie mentioned something about covenants and how to deal with that with the bank. So maybe Katie, do you want to start, and then we'll go to Mustafa?
Sure. A couple of things. I've seen in the last couple of weeks, month or so, where banks have arbitrarily come out with some fairly restrictive requirements, just general blanket requirements. And this is where your communication and transparency and your working relationship with your financial institution is so critical. You know, typically, I tend to say, oh my gosh, look what they're doing to me. But really, it's an open dialogue. And, you know, the best thing you can do is really have that hard conversation with your financial institution. They don't want to typically see their customers, you're a customer, they don't want to see them go down. They want to try and support you and work through it. So yes, I have seen some tightening of requirements. The biggest thing is having very clear direction on your cash forecast and your business forecast, at least on a 13-week or a shorter time frame, rolling forecasts. It gives a lot of confidence to your financial institution. And then also, if you're asking for your debt covenants to be relaxed or waived, if you're asking for a debt service holiday, have a firm plan going into that discussion as to how and when you think you're going to be able to resume normal financing operations with your financial institution. Mustafa, anything to add on that?
I would certainly echo Katie, what you just mentioned. So key things. Number one is strong financial institution relationship. Number two is your projections, your forecasts, how confident the financial institution is on your projections that you've prepared. And as I always say, you've rightly said, Katie, that we are their customers. We are a bank's customers. So definitely it is in their interest to serve us. And it is part of their business to serve us. So what they look for, what the bankers are looking for, is the credibility of the management itself. What kind of experience they have, what kind of background they come from, and all that. And do they have a history of actually taking companies through some of these, well, this is unprecedented time, but still some of the challenging times that we might have experienced in the past. So these are definitely the things that banks look for. One good thing that the governments have done is they have started to provide these guarantees, so to speak, which gives banks a little bit of assurance as well that yes, 80% of the debt, let's say if I'm extending to company XYZ, is backed up, is guaranteed by the BDC or EDC. So it helps.
I'd like to just add too, and this goes back to Mustafa's discussion about the controller's forecast versus the treasurer's forecast. At this point in time, it's really, really critical that everybody in a company adopts a cash mindset. Cash is king. And, you know, I like to say, think like a CFO. This is the prime opportunity. So, you know, one of the things, depending on the size of the company, is you need to have that cash war room that is a cross-functional team across the organization. The inputs for your cash forecast are going to be much clearer if you've got every key person at the table talking about cash, talking about how to protect the business, and building those plans that you can use to communicate with your key suppliers in your financial institutions.
Scott, you were saying something as well?
I think just around your point about the cash flow forecast and what the bank and financiers look for there. Given the impact that, you know, the COVID situation is having on revenue, I think it's very important to reflect that in the cash flow forecast. We're still seeing some, when I see an application from a company that's, you know, we've seen them take action, we've seen them revise revenue or funding projections in light of the situation, it really adds some weight to that issue of management and how they're running their company. So I think that's an important point, is to show that you've thought about the situation, demonstrate how that's going to impact your business and how you're going to plan forwards.
Great, thank you.
This is a time where, you know, your distribution channels have perhaps changed significantly. You know, businesses that weren't typically in e-commerce or online business to sell their products, it's really important that, you know, you do look at, is this something that's happening in the moment, or is it something that's going to be sustainable over the longer term and can be built out? And also looking for other revenue streams, looking at your products and saying, can we be tweaking them or distributing them in different ways?
Great. Okay, so a couple more questions for me, and then I'm going to turn it over to Mark to ask I think there's about 8 to 10 of them in the audience panel. So first of all, Doug, question for Doug. Have you seen any, or actually a general comment about your experience with CRA during COVID on the shred side? Have, you know, they were sort of out of commission for a while. I'm not sure if they're back. I don't know if they tightened up at all or loosened up. So just general comment on what your experience has been from the CRA's audit side.
Yeah, sure. From what I've seen and my colleagues have seen, they're not really going hard on audit. So I think if there's something they really hate, they will probably put it on hold. If there's something and then audit it later. But I think if there's something they don't like, they'll probably let it go, if you see what I mean. But I'm seeing that, and what my colleagues are seeing is that they're not at the same level of audit diligence as they have been. I don't know what you've seen, Scott.
Yeah, that's what I've seen as well. I mean, the priority, and I think this comes from the highest level of governments, is to get the money into businesses as quick as they can, and support businesses that claim SR&ED and might otherwise not have access to the other financing options that the government's made available. So they're definitely pushing that money through, but CRA have stated that they do reserve the right to retrospectively audit. So when it comes to SR&ED, I mean, this year might be an easier one, but going forwards, if you've made a claim that you can't substantiate, you're going to be in a lot of trouble. If you get retrospectively audited and you end up owing the CRA a couple of $100,000, I mean, that's not good for any business.
Something that I've seen in the past is when you do a claim after you filed your tax, usually they decide to audit it or they pay you. When you do it jointly, as in when you file your tax return with the SR&ED included, they'll often just pay out and then they'll decide to do an audit. And that's, the best of times. So I wouldn't assume that it's necessarily going to be any different now. So I certainly wouldn't recommend that a bunch of companies put through shoddy SR&ED claims in the hopes they'll get through. But at the same time, I think you can expect to see your money quicker, and the CRA isn't going to maintain a huge backlog. They can only process so many audits. It's fairly expensive for them. So they're probably going to let the less bad stuff, or the stuff they're merely curious about, go through for now. And next year could be a different matter.
Great, thank you. So one more question for me, for Scott, and then we'll turn it over to Mark. Have you seen during this pandemic any sort of alternative sources of financing become more popular as a result of the pandemic, or sort of similar pre-pandemic?
I don't think I've seen any become more popular. I think there's obviously more demand. I think the government's doing a good job of filling the gap over the short term. How that plays out over the next 6 months is another question. Basically, businesses are looking to fill a hole that revenue might provide, or raising capital might provide. So those markets have kind of slowed down as well. So I guess interim financing, bridging financing is an option. Whether I don't have any insight as to whether that's picking up or going down, but there's definitely more demand to fill those gaps in the short term with products that fit that role.
Great, thanks. And so over to Mark to ask some other questions.
Thanks, Mark.
Thanks, Melanie, and thanks for the panel, for all of you for being on. That's fantastic. Great tips, a lot of suggestions. For those of you that don't know me, because I wasn't introduced at the beginning, my name is Mark Belache. I'm president of BizOn Capital Corporation, and I'm partnered with Bruce as well for this event. So thanks, Bruce, for the invite as well. So the question, first, there's 6 or 8 questions, so we'll try to go through these as much as possible in the last 10 minutes that we have. So kind of open to everybody is what are some of the options for building costs for buildings which have been idle for the past few months and might remain underutilized for the foreseeable future? It's open to anybody.
That's probably a SR&ED question, I suspect. Or maybe it's a financing question.
It sounds like a financing question.
Yeah.
Any takers?
I'm giving it some thought right now.
Yeah, I saw that one pop up. I don't have anything specific on that besides lending against the building if you're the owner. I mean,
That's
the
what I
obvious
was going
one.
to say.
If you're leasing it, yeah, I'm not too sure.
Well, I think, along the lines of financial institutions, if it's a leased facility, having that open, transparent dialogue with the landlord or the owner of the building is going to be critical to going forward, and what the relationship is going forward. In terms of owning a facility, I agree with what Scott said in terms of if it's an unencumbered asset, you can be using it as a source of cash flow in the short term by doing either a term loan on the building or using the facility to guarantee your existing and extended lines of credit.
Okay, great. And of course, for the ones that are that are leased out, there's the Canada Emergency Commercial Response Assistance Program, right? CRA. Please explain the supply chain financing again and the process involved with the suppliers and banks.
Sure, I can definitely answer this question. As I say, one of my favorite topics. So supply chain finance is a banking product. There are definitely fintechs out there who provide this service as well. Number one thing to look at is your own company's credit rating. How does it stand? If it is, say, B pluses and that kind of rating, you definitely have a fair chance. Basically, contact your banks. My recommendation is maybe do an RFP with the banks who could provide you a better rate. Evaluate the companies, evaluate different banks, maybe throw in, since you're doing the RFP, throw in fintech there as well, company there as well. I'm not going to name any of these companies just for non-aligned sake. And then basically the way it works is, the technicalities of this is, you have a certain credit rating and your supplier has a certain credit rating. When your supplier raises an invoice to you, based on your credit rating, they could be able to get paid from the financial institution that you're partnering with, a payment which is quicker. So say your general terms are, suppliers are used to getting paid in 30 days. You want to extend your payment terms to 90 days. Your supplier could still continue to get 30 days paid back, but the margin, the premium that they would get charged from the bank would not be based on that supplier's credit rating, would be based on your credit rating. So if your credit rating is good, you definitely can benefit your suppliers with that. So I hope I answered, clarified the product.
Awesome. Okay. A couple of SHRED questions, yes and no kind of questions. Well, in a way, is it possible for SHRED to apply to nonprofits?
Well, I'm going to give you two answers. So the first one is no, but probably you don't like that answer. So I'll give you another one, which is yes, and I'll explain both. So in order to claim SHRED, you have to pay tax, and nonprofits by design don't pay tax. But what if the nonprofit owned another corporation that was for profit? So it's a higher overhead way of doing it. So you better be sure that you're doing enough SHRED to make it worth all the effort of setting that up. And I have seen it done, and I've seen it done in cases where it didn't necessarily work out so well. So you want to be, in terms of, there wasn't the SHRED they thought there would be. So you want to make sure that it's worth the effort. But if a nonprofit is going to do a significant amount of SHRED and significant expenditures, there are ways to do it. In terms of the detailed mechanisms, I think it's beyond the scope of what we're doing here. And it's also really a question for an accountant, how to set that up. But it is possible, indirectly.
Very good. So there's a couple of general questions that kind of are along the same lines to do with the SHRED, which is like how should one, are there certain consultants that focus on certain industries? Like what should someone do if they're in a food industry or manufacturing or whatever? How should they go about finding the right consultant for them, or what do you recommend?
Yeah, it's a great question. There certainly are consultants that focus in certain areas. My view is that a consultant with a lot of experience, I mean, shred claims all follow the same kind of, at a high level, they all have the same structure. So if I can ask someone a question, even if I don't really understand their industry, I'll often be able to hear whether it's shred or not. It's always preferable, though, to have someone who has insight into the industry, because then they can ask better questions. So I think it is worth finding a consultant who can understand what you're talking about, and go beyond what you're saying, because I often find that I'll ask questions like, what did you do? And they start telling me, and it's not, they're telling me what I need to know about shred. So I need to ask the right questions to and understand a little bit about what they're doing, have some insight into that to really get the right information from them. So it's a matter of choosing a consultant that can understand what you're doing. And I definitely will give you better results.
Okay, great.
Recently, in one of the companies I was consulting with, I recently guided them as an internal person, guided them through the process. And this is where referrals, when you're interviewing shred consultants, referrals is really key, to check other companies' relationships with them and interview different consultants in different companies, just like you would any other consultant or supplier.
Absolutely. It is to an extent a relationship business as well. So you could find someone who's really technically great and maybe works really well with other people, and you just don't get along with them so well. So that's another consideration.
Yeah, for sure. I mean, we've got a network of consultants we've worked with across the country, ranging from single people right up to the big four, and a lot of it's relationship based at the end of the day, and it's how you get along with your consultant and their buy into your business as well.
Okay, last question. We're getting close to 12 o'clock here, Toronto time, Eastern time. So maybe we can go around real quick to each person to answer this question. Which financial institutions are more receptive now to new financing applications, be it loans or lines? If you have any suggestions, comments. Katie, why don't we start with you?
I think, again, if you have a good relationship with your financial institution, then, talk to them. But, I think all of the larger financial institutions are willing and wanting to help companies out there. So, because you have a working relationship with one of the big BMO or Scotia or RBC or these banks, doesn't mean that you can't talk to maybe a mid-cap financial institution or other players. I haven't seen in the last 4 months any, banks showing any preference or financial institutions showing any preference, but it is definitely an opportunity to look at alternative organizations. We don't think of a Manulife as a financial as a bank, but it is. And there are opportunities to talk to the smaller players as well.
Okay, sounds good. We're out of time here, so I'll throw it back to Bruce. And thanks very much for all of you for being on.
Yeah, thank you. Oh, thank you very much. This is great. Thank you for the discussion. I'm sure we helped a lot of people. And I just want to cut off very shortly. Tomorrow is part 2 of this event. We broke it down into 2. We have some great panelists. We'll talk about things like coming attractions. We'll talk about zero-based budgeting. We'll talk about how to cut costs without cutting muscle, because that's an issue. And so I just want to thank everybody. Just to bring everybody up to speed, what's happening this week at our end is we had this event today. The part 2 is tomorrow at 10 o'clock. And on Thursday at 2 o'clock, myself and Mark Balaish are presenting the first annual Canadian Virtual CFO Conference, okay, which is really cool. So far, we got about 15 speakers. We go big, okay? We have 15 speakers for that event, and you can just go to my LinkedIn or Mark's LinkedIn, and you'll see it all there, and you can sign up for that event too. So, but tomorrow again, please come back tomorrow. It'll be really, really good. We got some great speakers. And I thank everybody here today, the panelists for their contributions. I thank Christina, who's our marketing person who organized this. And I really appreciate today's effort and today's event. And on that note, everybody,
All right.
Thanks a lot.
Thank you.
Thank you.
Thank
Be
you.
safe.
see you
Very
tomorrow.
much.
Be
See you
safe
tomorrow.
and
Take care,
keep
everybody.
healthy.
We'll see you tomorrow. Bye-bye.
Bye.